So if you've been keeping an eye on the markets, you probably couldn't miss this one. CoreWeave Inc., ticker CRWV. August 13th, 2025. The stock just tanked. I mean, down over 20% in a single day, closing around $117.76.
Yeah, a huge move.
Huge. And this is a company that's already, pretty viable. It hit a high of $187 back in June.
Right, and then the low was what, $33.51 back in April? So wild swings.
Exactly. And the amount of news, just the sheer noise around CoreWeave right now, it's intense, especially if you're tracking anything in the AI space. The big question, I think, is just, what is going on here? What's behind such a roller coaster?
It's definitely complex, and I think to really get it, you first need to understand what CoreWeave actually does. They run this really critical cloud platform. They're providing these very sophisticated computing solutions specifically for AI.
Basically, yeah. They're building that foundational infrastructure, GPUs, CPUs, storage, networking, all the heavy lifting stuff that generative AI needs. Yeah. And you always see them mentioned as Nvidia-backed. That's not just a casual thing.
Right. It points to a really deep strategic relationship with Nvidia, which really cements their place in this whole ecosystem. Plus, you have to remember, they only went public recently. IPO was March 28th, 2025.
Still pretty fresh then.
Very. And then boom, August 14th. That was yesterday for us recording this. A big lockup expiration hit. A ton of shares held by early investors and employees suddenly became tradable.
Okay. So that adds selling pressure.
Exactly. Analysts were definitely flagging that as a potential drag on the stock price, adding fuel to the fire on a day when other news was already hitting. It was kind of a perfect storm.
Okay, so let's zero in on that, because the timing was strange too, right? The broader market, Dow, S&P, NASDAQ, they were all rallying yesterday, August 13th. There was optimism about potential rate cuts, but CoreWeave just went completely the other way. What was actually in their Q2 earnings report that spooked investors so much?
Well, this is where it gets really interesting, because the report was kind of a mixed bag, a very mixed bag. On the one hand, you had revenue. Q2 revenue came in at $1.21 billion.
Which sounds huge.
It is. That's a 207% increase compared to last year. They more than tripled revenue in 12 months. It's incredible growth. And they didn't stop there. They actually raised their full-year revenue guidance, now looking at $5.15 to $5.35 billion.
So beating expectations on the top line.
Clearly beating them. It shows just, absolutely massive demand for what they offer. But, and this is the big but, the company also posted a pretty significant net loss, $291 million for the quarter.
Okay.
And the adjusted earnings per share, the EPS, that came in at negative $0.60.
Ouch. How did that compare to estimates?
That was the problem. Analysts were expecting a loss, but more like negative $0.20 per share. So a big miss in the bottom line.
Right, so massive growth, but also burning through cash faster than expected.
Exactly. It shows that even with demand absolutely surging, profitability is still a real challenge. They're spending heavily, way ahead of the revenue, just to scale up their infrastructure fast enough.
That really is the classic growth story paradox, isn't it? Exploding sales, but losses and costs are climbing too. So what does this actually mean for their financial health, their stability?
Well, if you look deeper, scaling like this costs a lot of money. And you see that clearly on their balance sheet. Take interest expense. In Q2, it was $267 million.
Just an interest?
Just interest. And compare that to $67 million the year before.
Wow, that's quadrupled.
Pretty much. And it's mostly because they've taken on a huge amount of debt to fund all this building, this infrastructure expansion. Their total debt now, $8.7 billion. And that debt to equity ratio, it's up there, 283.8%.
So nearly 3 times more debt than equity. That sounds aggressive.
It is aggressive financing. And, it naturally raises questions about their cash runway. How long can they keep spending like this? Based on their current free cash flow burn, estimates put that runway at less than a year.
Less than a year. For a company growing this fast, that sounds, well, concerning.
It could be, yeah. In this kind of capital-heavy business, a short runway usually means you either need to keep raising money or make some big changes to your spending.
Okay. That sounds quite risky, that level of debt and that cash burn. But then you also hear reports about how successful they've been at raising money. How do those two pieces fit together?
Yeah, and that's sort of the other side of the coin, and maybe why the market gives them some leeway. It shows how much confidence there still is in the whole AI infrastructure play. CoreWeave has been incredibly active fundraising. Since early 2024, they've pulled in over $25 billion. That's a mix of debt and equity.
$25 billion.
Yeah, huge numbers. They've done multiple high-yield bond offerings. Those typically cost more because they're seen as riskier. But more recently, They closed a big $2.6 billion loan, a delayed draw term loan, at a much better rate.
How much better?
Significantly better. It was priced at SOFR plus 400 basis points. SOFR is that benchmark rate. That rate represents a 900 basis point decrease compared to their previous loan facility. That's a massive improvement in their borrowing costs.
So even with the losses and the high debt, lenders are actually giving them better terms.
It seems so. It suggests that despite the current financials, their access to capital markets is still strong, maybe even getting stronger. Investors are clearly betting big on the long-term story here. They see the demand, the scarcity of this kind of AI compute power, and they figure CoreWeave can capture a big chunk of it, making profitability a later concern. It's a land grab.
So it really does sound like all these financial moves, the debt, the constant fundraising, it's all being driven by just this intense, almost overwhelming demand. Can you paint a picture of that market environment? You said it's like building a highway during rush hour.
That's a good analogy. The CEO uses the term structurally undersupplied. Basically, there's just way more demand for specialized AI cloud services than there is supply. And that's not slowing down. They ended Q2 with almost 470 megawatts of active power for AI stuff.
Okay.
Their goal is to hit over 900 megawatts by the end of this year, so nearly doubling capacity again.
And is this just hope, or do they have customers lined up?
Oh, they have customers. Their contracted backlog, that's future revenue already locked in from signed deals, has doubled just since the start of the year. It's at $30.1 billion now.
$30 billion.
Secured.
Secured, yeah. And it includes big expansions with major players like OpenAI. That's a huge validation. Plus, new wins in all sorts of areas. Financial services, you've got Jane Street, Morgan Stanley, Goldman Sachs jumping in. Healthcare, like Hippocratic AI. Even media, like Moon Valley.
So it's broadening out beyond just the core AI developers.
Definitely. And they're seeing a really big uptick in workloads for what's called AI inference. The CEO calls inference the monetization of artificial intelligence because that's when the AI models actually start doing real work, making predictions, generating content, providing value, moving from training to production.
Okay, this is where I find it gets really fascinating. They aren't just adding more servers or building more standard data centers. They're making strategic moves, acquisitions, vertical integration. Tell us about that. Seems aggressive for a relatively young public company. Yeah, it is aggressive, but it seems quite strategic. They talk about verticalizing their platform up the stack and down the stack.
Meaning?
Well, up the stack means closer to the customer's applications. They bought a company called Weights and Biases. That deal brought in like 1,600 new clients. But more importantly, it lets CoreWeave offer more integrated tools, things for observability, managing AI models, new products specifically for inference.
So making their service stickier, harder to leave.
Exactly. Embed deeper into the client's workflow. Then, down the stack is about controlling the fundamental infrastructure. They've put in a bid to acquire Core Scientific.
Ah, the Bitcoin miner that went through bankruptcy.
That's the one. But they have massive power capacity. If that deal goes through, it would add about 1.3 gigawatts to CoreWeave's portfolio. And the projections are pretty huge. They think it could eliminate $10 billion in future lease costs they'd otherwise have to pay.
$10 billion.
Yeah. And lead to maybe $500 million in annual cost savings by the end of 2027.
So owning the power source, basically.
Owning more of it, yeah. Owning the power, the facilities. It's all about controlling costs long term, ensuring they have the power they need, and just making their whole operation more efficient and resilient as they scale up massively. It's a bold play to control their own destiny.
It really seems like they're trying to anticipate different needs too, right? Like managing the compute resources for AI training versus this inference piece you mentioned. How flexible are they there?
That's a key part of their design philosophy. They build their infrastructure to be fungible.
And fungible.
Meaning they can switch the same hardware between training workloads and inference workloads pretty seamlessly. Training, takes tons of power for a long time to build the model. Inference is different. It's the model running, doing its job, often in short bursts, but happening constantly.
And you said inference demand is growing.
Significantly, which makes sense, right? It means AI is moving out of the lab and into the real world. And what's clever is they're also repurposing their older GPUs, like the Nvidia A100s and even the H100s, as newer generations come online. They're recontracting them mostly for inference tasks on new deals lasting 1 to 3 years.
So sweating the assets longer, getting more value out of that expensive hardware.
Exactly. It extends the life cycle, maximizes their return on investment. That kind of flexibility is a huge advantage when demand is so high and hardware is constrained. They can use every bit of capacity they have.
So wrapping this all together, the stock drop, the mixed earnings, these big strategic plays, the massive fundraising.
Yeah.
Where does this leave CoreWeave now? What are the analysts, the insiders saying about the outlook?
Well, if you look at Wall Street analysts, the consensus reading right now is actually neutral. It's a mix, some buys, some holds, some sells. And the average price target is around $109.86.
Which is below where it's trading now, even after the drop.
Right. Even after that 20% drop, the average target is still lower. So that suggests maybe some caution, some skepticism among the broader analyst community, despite all the growth hype.
What about insiders, people within the company?
Insider ownership is actually quite high. Individual insiders own nearly 30% of the company.
That usually signals confidence, right? Skin in the game.
Usually, yes. It suggests strong internal belief in the long-term vision. However, if you look at recent transactions, it's a bit mixed. You see some insider sales alongside option exercises. Option exercises are often just part of compensation, but seeing sales too, the market can interpret that in different ways.
So mixed signals there too. Strong ownership, but also some selling.
Exactly. It really paints a picture of, significant belief from within about the strategy in the future, but maybe some nervousness or differing views on the current valuation or the short-term stock path.
Wow. What a story. CoreWeave Inc. It's just,
No, that's
it's such a fascinating snapshot of the AI boom, isn't it? You have this company right at the absolute center of it all, facing this incredible, maybe unprecedented demand and just scaling like crazy.
Yeah, breakneck pace.
But at the same time, they're juggling these really significant financial hurdles, profitability is elusive, debt is piling up while trying to build this colossal infrastructure.
Yeah.
It really is that high-growth, high-cost narrative, but just amplified by the sheer scale and speed of AI. It feels like a classic Silicon Valley bet, just on steroids.
Absolutely. And looking at CoreWeave really shows you that the fundamental infrastructure layer for AI, it's still very much under construction. The dynamics we talked about, how you scale that fast, how you manage that much debt, how you capitalize on overwhelming demand, even if it means losing money, short-term understanding, that is crucial if you're watching this space. It's a race. So I guess the real question for you thinking about this is how long can a company keep up this kind of hypergrowth, this level of intense investment before the actual profits from the AI revolution start to catch up with these massive foundational costs? And what does that inflection point look like?